Alright, welcome back. We continue in this next clip. We follow on from the previous clip. Okay, as we were looking, this is a recap of what we saw in the previous clip. Okay, this would be all, these are all the equations that you need for the cash flow statement. There is another version of these equations, and we'll see this in the next slide. Here. Alright, as you can see here. Now, these other equations here are the same. Okay, these equations are the same as previous slide. The difference here is with this net capital spending. Equals to, in the previous equation we saw change in net fixed assets. Now here we have net fixed asset present now, current year or current time, minus net fixed asset at the previous time. So this is actually the change in net fixed asset. That's the only change that we have made for this equation. The other equation that we change, slight change, is that this is net working capital change. Okay, and in the previous equation we had change in net working capital, but here we change it to net working capital at the end of this year or the present year minus net working capital at the end of the previous year. So this is change in net working capital, or we can take current assets year 1 minus current liabilities year 1 minus current assets year 0 minus current liabilities year 0. So this is a difference. There's a difference in current assets, minus the difference in current liabilities. So it's the same thing. Right. And here also we introduce a different equation. CFTC, or cash flow to creditors, is equal to I, or interest, minus change in long-term debt. We replace this change in long-term debt with long-term debt year 1 minus long-term debt at year 0, or previous year. Okay, and the final equation is this. You may not be able to see the full equation. Let me just drag this down a little bit. Cash flow to stockholders or shareholders is equals to dividend minus change in common stock. That's one way, or we can write it this way: common stock year 1 minus common stock year 0, or net income minus, rather than change in equity, we state this as equity at year 1 minus equity at year 0. So these are the various equations that you need to remember. If you can't understand the derivation, then memorize all these equations in order to solve problems with related to cash flow statement. Alright, let's look at the cash flow statement framework, and this is actually a quick review of what we have covered so far. Now, CFFA, or cash flow from assets, this would determine or will show you the cash generated from using the assets of a business or a firm. Now, this is made up of 3 components. One is the operating cash flow. This is cash flow from operations, OCF, or cash flow from operations of the business. The second component of CFFA is net capital spending. This can mean, again you can't see the full, let me just drag it down a little bit more. Alright, cash used for or raised from fixed assets of the business. So this can be either positive or negative. If the cash is used to increase fixed assets, then it is a use of cash. So it will be a cash outflow. So you minus the NCS. But let's say you sell the fixed assets in order to generate cash flow. So therefore this NCS will be negative. There will be a cash inflow. Therefore you minus negative NCS Therefore, you add, so it will be a cash raised from the sale of fixed assets. Now, the third component of CFFA, or cash flow from assets, will be change in, a moment here, it's not appearing, okay, change in net working capital or net working capital change. This would mean cash used for or raised from working capital. So if a business increases its working capital, it will be a use. This will be positive, and you minus this positive number. Therefore, it's a cash outflow. But let's say you reduce your working capital. That means you release some cash that the business can use for other purposes. Therefore, this will be cash raised from reducing your working capital. So this is the left-hand side of the equation, or the framework of the cash flow statement. Now, on the right-hand side, you have cash paid to capital providers. Cash flow to capital providers will be cash paid to capital providers. And this is made up of two components. Okay, the first component is cash flow to creditors. Okay, this is cash paid to or raised from creditors. So if the company issues debt securities to the creditors, okay, then this will be a cash inflow, not a cash outflow. So it will be cash from creditors, not cash flow to, cash flow from creditors if it is negative. But if it is positive, then cash is paid to the creditors. Alright, then the second component and the last component here will be the cash flow to shareholders, CFTS. This would indicate cash paid to or raised from shareholders. Okay, this also can be positive or negative. It is positive. If it is positive, then cash is paid to the shareholders. But if it is negative, then cash is raised from the shareholders. And in this cash flow statement, these two must be equal. Remember, this is based on the premise of the balance sheet identity. So if assets is equals to liabilities plus equity is true, and it must always be true, therefore these two, the CFFA must always be equal to CFTCP, or cash flow from assets must always be equal to cash paid to capital providers or cash flow to capital providers. Is that okay? So with that, we finish this particular component or key point of this chapter, the final key point. But we will look at an example where we try and solve this. This is just a review. Okay, we'll skip that. It's just a review of what we have I've shown you in the previous slide. Now we try and use this US corporation example. And we try and show how this example can be applied in terms of coming up with the cash flow statement. For that, we will look at the Excel. Okay, let me just drag this so that you can see it. Okay. You can see it clearly here. Okay, so here we have this example, the US corporation example in slide. Okay, so this is the balance sheet for 2018, and this is the balance sheet for 2017. So you have 2 years. And then at the bottom, if you go at the bottom, okay, you also have the income statement here. So the ones above here, you have the balance sheet, and here you have the income statement. Alright, now we want to derive the cash flow statement for 2018. Remember, the cash flow statement ties up or is derived from 3 statements. The balance sheet for this year, this is here, and the balance sheet for the previous year. Okay, this is given here, this column, and also the income statement for this year, which is given here. Okay, so we have all the 3 statements, and then we can derive the cash flow statement. So the cash flow statement is made up of two components. The first one is cash flow from assets. This is in green here, okay? And it is made up of three components: operating cash flow, net capital spending, and change in net working capital, yeah? And the second component of the cash flow statement is cash flow to capital providers, made up of two components, yeah? Cash flow to creditors and cash flow to stockholders, yeah? So that is what we are going to look at. Let's look at the first element, yeah? In cash flow from assets, we start with the left hand side in the equation. So we start with operating cash flow, or OCF, yeah? OCF, remember the formula, it is made up of three components. One is earnings before interest and tax, you plus depreciation, and you minus tax, yeah? So earnings before interest and tax, this amount is taken from the income statement, yeah? If you go down here, the income statement, earnings before interest and tax is 694. So you add 694 here, alright? It is here. Then you add depreciation. Depreciation is also, this amount is also from the income statement, which is here. Okay, depreciation is here, 65. So you add that here. Alright, 65. Then you minus tax, yeah, 131 here. That is taken from also the income statement. Tax is 131 here. So you minus that, yeah. Remember the equation, it is always earnings before interest and tax plus depreciation minus tax. So the operating cash flow, or OCF, is this 694 plus 65 minus 131. Therefore you get 628. That is the operating cash flow, yeah. That is the first component. Now the second component of the cash flow from assets is net capital spending, or NCS. Okay, now this NCS is made up of three components, yeah, or three elements. The first one is ending net fixed assets, NFA 1, yeah. So this is the net fixed assets at the end of 2018. You can take it from here, net fixed asset 1709, that is here, minus the NFA at time 0, yeah, that is the previous year, so 1644, yeah. So this is from the balance sheet, yeah. Here these elements are all from the income statement. Here these two elements are from the balance sheet. Alright, yeah. Then remember, this is minus, yeah, this is positive, this is minus. Then you add depreciation, yeah, that is NCS, yeah. Remember the formula for NCS. So NCS, you again, yeah, add depreciation. Remember, you add depreciation here and you also add depreciation here, yeah. Right, so here you have depreciation, okay, added on both above and also here, yeah. So you add this, yeah, this minus this, then plus depreciation. Therefore you get 130, yeah. So this positive indicates that cash outflow, yeah, or used, okay. So that means the company used, okay, $130 million, if these are in million, or you can just say, accept that as dollars. $130, yeah, was spent in increasing the fixed assets of the company. Okay, what does operating cash flow tell you? Yeah, 628 means the company generated, yeah, $628 in terms of operating cash flow for that year. Okay, and the third and final component of the cash flow from assets is change in net working capital. Remember the formula for that? It is the ending net working capital. Okay, ending net working capital will be here, yeah. You have total current assets, okay, minus total current liabilities, yeah. That will be your ending net working capital. And the beginning net working capital will be total current assets for 2017 minus total current liabilities for 2017. So therefore it is 684. Okay, negative, yeah. So that will be your change, yeah. So here it means 391 and it is positive. That means the ending net working capital is greater Then the beginning net working capital, it means that the company has used cash.